In the world of personal finance, there's a three-digit number that holds immense power: your credit score. This mysterious number can determine whether you qualify for a loan, rent an apartment, or even secure a job. Understanding your credit score is crucial for navigating the financial landscape. Simply put, your credit score is a numerical representation of your credit worthiness. It tells lenders how risky it is to lend you money based on your past financial behavior. A higher score indicates lower risk, making you a more attractive borrower. Think of it like a report card for your financial responsibility. Just like good grades open doors to better opportunities, a good credit score unlocks a world of financial possibilities. So whether you're just starting or looking to improve your financial standing, understanding and managing your credit score is paramount. Let's delve deeper into the factors that influence this all-important number and how you can take control of your financial future. Your credit score isn't arbitrary. It's calculated based on 5 key factors, each carrying a different weight. First, payment history. This is the most crucial factor, accounting for about 35% of your score. It reflects your track record of paying bills on time, including credit cards, loans, utilities, and even rent. Second, amounts owed. This factor, representing 30% of your score, considers how much debt you have relative to your credit limits. It's not just about the amount of debt, but also your credit utilization ratio, the percentage of available credit you're using. Third, length of credit. History. Making up 15% of your score, this factor considers how long you've been managing credit. A longer credit history generally indicates lower risk. Fourth, credit mix. Accounting for 10%, this factor assesses the diversity of your credit accounts, such as credit cards, installment loans, and mortgages. A healthy mix demonstrates your ability to manage different types of credit. Lastly, new credit. This factor, representing the final 10%, considers how often you apply for new credit. Frequent applications can be a red flag for lenders, suggesting potential financial instability. Your credit score's impact extends far beyond loan approvals. It touches nearly every aspect of your financial life, influencing the interest rates you pay, the insurance premiums you're offered, and even your employment prospects. A good credit score can save you thousands of dollars in interest payments over your lifetime. When you have a high score, lenders view you as a low-risk borrower, offering you lower interest rates on loans and credit cards. Conversely, a low credit score can lead to higher interest rates, making borrowing more expensive. It can also limit your access to credit altogether, making it challenging to finance significant purchases like a home or a car. Beyond borrowing, your credit score can impact your insurance premiums. Many insurance companies use credit-based insurance scores to assess risk, with higher scores often translating to lower premiums. In some cases, employers may even check your credit report as part of the hiring process, particularly for positions that involve handling finances. A good credit score can demonstrate financial responsibility and trustworthiness. Improving your credit score takes time and effort, but the rewards are well worth it. Here are some practical tips to get you started. First, pay your bills on time. This is the single most effective way to improve your credit score. Set up automatic payments or reminders to ensure you never miss a due date. Second, reduce your credit utilization. Aim to keep your credit utilization ratio below 30%. Pay down your balances strategically, focusing on cards with higher utilization rates. Third, don't close old credit accounts. Even if you're not using a credit card anymore, keep the account open to preserve your credit history. The longer your credit history, the better. Fourth, become an authorized user. If you have a trusted friend or family member with good credit, ask to be added as an authorized user on their credit card. This can give your score a boost, but ensure the account is managed responsibly. Lastly, dispute errors on your credit report. Check your credit report regularly for errors and inaccuracies. You can dispute any mistakes with the credit bureaus, which are legally obligated to investigate and correct them. Section 5. The Credit Utilization Conundrum. Finding the sweet spot for a healthy score. Credit utilization, the ratio of credit you're using to your total credit limit, plays a significant role in determining your credit score. Understanding how to manage this ratio is crucial for maintaining a healthy score. Imagine you have a credit card with a $10,000 limit, and your current balance is $3,000. Your credit utilization ratio is 30%. Keeping this ratio below 30% is generally recommended, as it shows lenders you're not relying too heavily on credit. High credit utilization can signal financial stress and increase the perceived risk for lenders. Conversely, having a very low utilization ratio, while not necessarily bad, might not reflect your full creditworthiness. To optimize your credit utilization, consider these strategies. Spread your spending across multiple cards. Instead of maxing out one card, distribute your purchases among several cards with available credit. Request credit limit increases. Contact your credit card issuers to request higher credit limits. This can help lower your utilization ratio, but avoid increasing your spending. Make multiple payments throughout the month. Instead of making one large payment at the end of the billing cycle, consider making smaller payments throughout the month to keep your balances low. Section 6. Time heals all scores. The role of credit history in your financial journey. Your credit history, a record of your borrowing and repayment behavior, is a crucial factor that influences your credit score. It provides lenders with insights into your financial responsibility and how you've managed credit over time. The length of your credit history is particularly significant. A longer history generally indicates lower risk, as it demonstrates a more established pattern of borrowing and repayment. Conversely, a shorter credit history can make it challenging to obtain credit, as lenders have limited information to assess your creditworthiness. Building a positive credit history takes time and consistent effort. Here are some tips to establish and maintain a healthy track record. Start early. The sooner you start building credit, the better. Consider opening a secured credit card or becoming an authorized user on a trusted account to establish a credit history. Don't open too many accounts at once. Each new credit application can result in a hard inquiry on your credit report, potentially lowering your score. Space out your applications to minimize the impact. Maintain a mix of credit accounts. Having a variety of credit accounts, such as credit cards, installment loans, and mortgages, can demonstrate your ability to manage different types of credit responsibly. Section 7. Safeguarding your score. Protecting your credit from fraud and errors. In today's digital age, protecting your credit score from fraud and identity theft is more critical than ever. Here are some essential steps to safeguard your financial well-being. Monitor your credit reports regularly. You're entitled to a free credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, every 12 months. Request and review your reports at annualcreditreport.com to identify any discrepancies or suspicious activities. Be cautious with personal information. Be wary of phishing scams that attempt to trick you into revealing sensitive financial information. Legitimate companies will never ask for your social security number or account details via email or phone. Use strong passwords and two-factor authentication. Create strong, unique passwords for all your financial accounts and enable two-factor authentication whenever possible. This adds an extra layer of security, requiring a secondary verification code in addition to your password. Report lost or stolen cards immediately. If you suspect your credit card has been lost or stolen, contact your credit card issuer immediately to report the incident and prevent unauthorized transactions. Section 8. The Credit Score Myth Busters. Separating fact from fiction. There's a lot of misinformation surrounding credit scores. Let's debunk some common myths. Myth 1. Checking your credit score hurts your credit. Fact. Checking your credit report for your own reference is a soft inquiry and doesn't impact your score. Only hard inquiries, typically initiated by lenders when you apply for credit, can potentially ding your score. Myth 2. Closing a credit card you don't use improves your credit score. Fact. Closing a credit card can actually hurt your score by reducing your total available credit and increasing your credit utilization ratio. Myth 3. You need a perfect credit score to get the best rates. Fact. While a higher credit score generally leads to better interest rates, lenders consider various factors beyond your score. Myth 4. Carrying a small balance on your credit card helps build credit. Fact. You don't need to carry a balance to build credit. Paying your balance in full and on time is the best way to improve your score. Section 9. Conclusion, your credit, your future, a lifetime of financial well-being. Your credit score is more than just a number. It's a reflection of your financial responsibility and a key determinant of your financial well-being. By understanding the factors that influence your score and adopting responsible credit habits, you can unlock a world of financial opportunities. Remember, building good credit takes time and effort. There's no quick fix. Focus on making consistent, positive financial choices, and over time, you'll reap the rewards of a healthy credit score. From securing favorable loan terms to accessing better insurance rates, a good credit score paves the way for a brighter financial future. Embrace the power of credit and watch your financial dreams take flight.